Market value is the lifeblood of investing. It is what points out the worth of a company or asset. It shows investors' sentiments, and tells whether they are optimistic, pessimistic, or indifferent. Market value helps determine whether an asset is undervalued or overvalued, guiding buy, sell, or hold strategies. Market value goes beyond figures. It is what shapes investment and its outcomes. Investment expert Mauricio Mendes Dutra says to ignore market value is to navigate the investment world blindfolded. That is why Mauricio Mendes Dutra goes deeper on what market value entails and everything you need to know. What is market value? Market value is essentially the price tag that the market assigns to an asset. It's the amount someone is willing to pay for something at a given moment. It is also the market capitalization of a publicly traded company, which is determined by multiplying the number of outstanding shares by the current share price. Unlike intrinsic value, which is a theoretical concept based on underlying fundamentals, market value is a tangible, real-time reflection of what buyers and sellers believe an asset is worth. This entails collective opinion. Market value is a collective one determined by the buying and selling activities of numerous market participants. Dynamic price. It's not a fixed value. It fluctuates constantly based on changes in supply and demand, economic conditions, investor sentiment, and company performance. Future expectations. Market value reflects investors' anticipations about a company's future earnings, growth prospects, and overall business health. Relative measure. It's a comparative figure. An asset's market value is assessed in relation to similar assets. Imperfect indicator. While market value provides valuable insights, it can be influenced by irrational behavior, market bubbles, and other external factors. Factors determining market value. There are different factors that come into play when it comes to market value, and these include supply and demand. This is the basis of market value. If demand for an asset, like a particular stock or real estate, outstrips supply, its price tends to rise. However, an oversupply compared to demand can reduce prices. For instance, a limited edition collectible with high demand but low availability will command a premium price. Investor sentiment. The participants' opinions, emotions, and expectations plays a huge role. When the participants are optimistic about a company's future prospects, this can drive the value, while negative feelings or uncertainties can bring it down. Economic conditions. Market value plunges during economic downturns and rises during economic expansion. Company performance. For publicly traded companies, earnings, revenue growth, and profitability are crucial determinants. Strong financial performance will increase market value, while declining earnings means decline in market value. For instance, companies like Tesla and Apple achieved constant earnings and their market value soared. Industry trends. The overall performance of an industry can impact the market value of its constituent companies. For example, the rise of e-commerce boosted the market value of online retail companies like Amazon. On the other hand, declining sales in a particular industry can negatively affect the market value of its companies. Risk perception. Higher perceived risk, such as in volatile markets or for companies in unstable industries, can depress market value. However, assets considered low risk, like government bonds in stable economies, tend to have higher market values. Sector. Market value can also be determined by the sector in which the company belongs. For instance, a company in tech can outperform other industries in market value even when they have the same annual sales. If it has a consistent flow of income and it is a high-growing firm, the market value will be higher than the others. How to calculate market value? It is easier to determine the market value of stocks and futures since their prices are easily available, but over-the-counter instruments like fixed-income securities can be challenging. Illiquid assets like real estate and businesses are the most difficult, and it might require expert hands for appraisal in order to determine the value, Mauricio Mendes Dutra explains. For publicly traded companies, calculating market value is simple and straightforward. Market capitalization, market value of equity. This is the most common method. Formula: market capitalization equals number of outstanding shares current share price. For example, if a company has 10 million shares outstanding and its current share price is $20, its market capitalization is $200 million. For assets like real estate, art, or collectibles, determining market value is more difficult. Mauricio Mendes Dutra says it often involves appraisals, hiring a professional appraiser to estimate the value based on comparable sales, condition, and market trends. Market analysis: studying recent sales of similar assets to establish a price range. Valuation models: using complex financial models to estimate the intrinsic value of an asset. Key takeaways: understanding market value can help investors identify undervalued or overvalued stocks and assess the risks involved in order to make informed decisions. Businesses can also businesses, which is vital in determining a business's worth, whether for mergers, acquisitions, or investment purposes. It will also be easy to raise capital through issuance of shares and attracting investors. White publicly traded companies need a strong market value to attract and retain investors. It will lead to more favorable terms in equity offerings and debt financing. While it is easier to determine the market value of shares, coming up with an objective market value can be difficult for illiquid assets.